If you're at the stage of building your investments, you've seen your portfolio drop and you're fearful of a crash, you're not alone. And crashes can be scary, especially if it's your first one. So firstly, breathe, and I'll explain 3 key steps on what to do when the market crashes, and more importantly, what not to do. So let's start with the big emotional traps to avoid. So the first one is panic selling, because it feels safe, but the reality is that it locks in your losses. And selling your investments at the sign of a crash or during a crash is a surefire way for you to lose your money. Secondly, is trying to time the bottom of the market. You're likely to miss the rebound. Putting yourself under this amount of pressure causes unnecessary stress. It's less about when you invest and more about how long you're invested for. So as long as you're looking at a time horizon of 5 or more years, it's sensible to get the money invested and just remove the guesswork. And the last emotional trap to avoid is following hype or influencers who don't know your situation. And you're going to see big flashing words saying sell now or get out while you can. And this is all scaremongering. It tends to trigger emotions that lead people to make rash decisions, which feels like it makes sense in the short term, but it very rarely makes sense in the long term. Markets move fast, but good investors move slow and steady. And one of the most successful investors that has ever lived, Warren Buffett, once said, "Be fearful when others are greedy and greedy when others are fearful." This is something that we have to take note of. So here's what smart beginners do instead. Firstly, stay calm. Investing is a long game and one crash won't define your outcome. 2 is to remember your emergency fund. If you followed the process correctly, you should have a cash buffer, and that is there so that you do not have to interrupt your investment. And 3 is to keep investing. Make monthly contributions, and during downturns, buy more shares. It's called pound cost averaging, and it all works over the long term. 4, stick to your original plan. If you had a goal before and it's still your goal now, stick to the goal. And number 5 is to simply zoom out. Look at any 10-year market chart and you'll see that crashes come and go and recovery is the trend. The last quote I'll give you from Warren Buffett is that the stock market is a device for transferring money from the impatient to the patient. So again, this is something that we have to take note of before we make rash decisions. So the nerves that you'll feel and the discomfort that you'll feel are the emotional costs for long-term gains. And if you want the reward, you have to pay the price because it doesn't exist without it. And chapter 15 of this book, The Psychology of Money by Morgan Housel, is called Nothing's Free. And in this chapter, it clearly demonstrates the idea of emotional cost. And one of the examples he uses is that Netflix returned more than 35,000% from 2002 to 2018, but traded below its previous all-time high on 94% of the days. So it's important to consider this before making any rash decisions on your long-term investments. You're probably doing better than you think. If this has helped you stay grounded in any way, please give it a like and subscribe and follow for more calm and clear investing guidance.